Every time you switch strategies, you're not adapting to the market, you're resetting your neural pathways back to beginner level. You think you're being flexible, strategic, smart. You're not. You're chasing the chemical hit that comes from novelty, and that chemical hit is costing you thousands of dollars every single month. Your dopamine system, the same system that kept your ancestors alive by rewarding exploration and pattern recognition, is now actively destroying your ability to make money in the markets. And you don't even see it happening because it feels like learning. It feels like progress. It feels like you're doing the work. But you're not building a trading account. You're building a tolerance to discipline. Let me be more specific about what's actually occurring in your brain when you discover a new trading strategy. Your ventral tegmental area releases dopamine the moment you encounter novel information that promises reward. This is the same neurochemical response you get from opening a notification on your phone, from seeing a like on social media, from buying something new. The anticipation of reward triggers the release, not the actual reward itself. So when you find a new strategy that looks promising, that has a compelling backtest, that makes logical sense, your brain gives you a hit of dopamine before you've even placed a single trade with it. You feel motivated, you feel excited, you feel like this might be the missing piece. And that feeling is chemically indistinguishable from actual progress. Your brain cannot tell the difference between the anticipation of success and actual success. This is why you keep searching for new strategies even though the last 7 strategies you learned didn't make you profitable. The searching itself is rewarding. The learning itself is rewarding. The implementation is where the dopamine drops off, where the work becomes repetitive, where the novelty fades, and where your brain starts scanning for the next hit. Let me show you what you believe that's killing you. You believe that the more setups you know, the more opportunities you can capture. You believe that market conditions change constantly, so you need to be ready with multiple tools in your arsenal. You believe that the professional traders you admire, the ones managing hundreds of millions or billions, have a deep bag of tricks they pull from depending on what the market is doing at any given moment. This sounds intelligent, it sounds adaptive, it sounds like how professionals in every other field operate. A surgeon knows multiple procedures, a lawyer knows multiple areas of law, a carpenter has multiple tools. Why wouldn't a trader have multiple strategies? But trading is not like other fields, and this belief is a trap that feels like wisdom until you look at your account history and realize you've been break-even or slightly negative for 18 months while studying 12 hours a day. The logic goes like this. More setups equals more opportunities. More opportunities equals more trades. More trades equals more profit. Seems linear, seems obvious. But here's the hidden consequence nobody tells you until you've already lost the money. Every new setup you learn doesn't just add to your skill set, it dilutes your existing pattern recognition, fragments your decision-making process, introduces lag time into your execution, and creates internal conflict at the exact moment you need certainty. You end up with a library of half-developed instincts, none of them sharp enough to trust when real money is on the line. You become a generalist in a field that only pays specialists. And the cruelest part is that you can see all the setups. You can identify them on historical charts. You can explain the logic. You can articulate the entry and exit criteria. But when price is moving in real time and your capital is at risk, you freeze. Not because you don't know what to do, but because you know too many things to do and your brain cannot process multiple decision trees simultaneously under pressure. Paul Tudor Jones started with $25,000. He built it into billions. And if you study his career carefully, if you go beyond the surface-level stories and look at what he actually did day after day, month after month, you'll find that he became known for one specific approach: identifying major trend reversals through a combination of technical and fundamental analysis, then leveraging those positions aggressively. One core edge, one approach, one filter through which he viewed every market. He didn't scatter his attention across mean reversion trades, breakout trades, range-bound scalping, volatility arbitrage, options strategies, and future spreads. He had a thesis about where markets were going, and he positioned himself accordingly. He waited. He studied macro conditions obsessively. He identified regime changes before they became obvious. And when his setup appeared, when all the conditions aligned, he attacked with size. What's more telling than what he traded is what he refused to trade. He refused to take small, choppy moves that didn't fit his thesis. He refused to trade markets he didn't understand deeply. He refused to be in the market just to be in the market. His inactivity was strategic, not passive. His waiting period wasn't a lack of opportunity or a lack of ideas. It was preparation. It was pattern recognition at a level most traders never reach because they never give themselves enough repetitions with a single approach to develop that sixth sense about when conditions are actually aligned versus when they just look aligned. Jones talks about spending months analyzing the crash of 1929, studying every chart, every news article, every piece of data he could find. Not because he thought 1929 was going to repeat exactly, but because he wanted to understand how markets behave during major trend reversals. This is depth. This is specialization. This is someone who understood that being exceptional at one thing beats being mediocre at everything. And he built a fortune on that understanding.
Think about a chess grandmaster looking at a board position. They don't analyze every possible move consciously. They don't calculate every variation. They don't check every piece on every square. They see patterns. After looking at tens of thousands of positions over thousands of games spanning years or decades, their brain has built neural shortcuts that allow instant recognition. When they see a fork opportunity, they don't think in words like, "Let me check if my knight can attack two pieces simultaneously." They feel it. The pattern recognition is so deeply embedded that it bypasses conscious thought entirely, bypasses language, bypasses the slow analytical parts of the brain. A novice chess player looking at the exact same position has to manually check every piece, every square, every possible interaction. The grandmaster operates from a different processing system entirely. The novice is using their prefrontal cortex, the slow, conscious thinking part of the brain. The grandmaster is using their basal ganglia, the fast, unconscious pattern-matching part of the brain. The same position that takes a beginner 3 minutes to evaluate takes the master 3 seconds, and the master's evaluation is more accurate because they're not thinking through it step by step. They're recognizing a pattern they've seen variations of hundreds of times before. And recognition doesn't trigger doubt. Recognition triggers action. When you trade a setup 5 times, you're thinking. You're consciously checking your rules, making sure the conditions match, second-guessing whether this is really the setup or just something that looks like it. When you trade it 50 times, you're analyzing. You're starting to notice which variations work better, which market conditions favor the setup, which subtle differences separate the winners from the losers. When you trade it 500 times, you're recognizing. And recognition is what allows you to pull the trigger at exactly the right moment without the internal debate that causes hesitation, without the need for 3 confirmations, without the fear that maybe you're wrong. Without hesitation, you get better entries. Better entries mean you're risking less to make the same amount. Better entries mean your stop can be tighter. Better entries mean you have more room for the trade to breathe before it either works or stops you out. Better entries mean better risk-reward ratios. Better risk-reward means you make money even with a 50% win rate or lower. This is not about being smarter than other traders. This is about having more compressed, automated pattern recognition than the trader on the other side of your order. The trader who sees it a half second after you do has already given you the edge. The feel a grandmaster has for the game is what separates an expert from someone who just knows the rules. In trading, this translates to something very specific, the ability to see your setup forming and execute without emotional interference, without doubt, without the need to check 3 other indicators to confirm what you already know. When you've taken the same trade structure 500 times, you stop asking yourself if this is really a setup. You stop second-guessing whether this time is different. You stop looking for confirmation from MACD or RSI or volume or some other indicator that isn't even part of your core methodology. You see it, you feel it in your body before your mind has time to articulate it, and you execute. The speed of execution becomes the edge itself, because in fast-moving markets, in markets where information is being processed by algorithms and professional traders with decades of experience, the difference between acting on the first signal and acting after 3 confirmations is the difference between a winning trade and a break-even trade, or between a break-even trade and a losing trade. The market rewards those who can act decisively on incomplete information, and decisiveness only comes from pattern recognition so deep that it doesn't require conscious thought. Your brain has built the shortcut. The setup appears, your hand moves to the mouse or keyboard, the order is placed, and the entire sequence happens before doubt has time to form, before fear has time to inject itself into the process, before your mind can come up with 7 reasons why this might not work. This is what mastery looks like.
This is what you're preventing yourself from reaching every time you switch to a new strategy, every time you decide the grass might be greener with a different methodology, every time you convince yourself that learning one more approach will be the thing that finally makes you consistent. Now, compare two traders side by side. The first trader has executed one specific setup 500 times over 2 years. The second trader has executed 10 different setups 50 times each over the same 2 years. Both have made 500 trades total. Both have studied the same number of hours. Both have access to the same charts, the same data, the same information. But when their respective setups appear on a live chart with real money at risk, the execution speed is completely different. The one setup trader sees the pattern forming and enters within seconds. They don't need to check their notes. They don't need to verify the rules. They don't need to look at multiple time frames to confirm. They've seen this exact pattern or variations of it hundreds of times before. They know what comes next. Their finger is already on the mouse. The 10 setup trader sees multiple possible patterns simultaneously. They see what might be a breakout. They see what might be a failed breakout, which is actually a reversal setup they know. They see what might be a range-bound scalp because price has been choppy for the last hour. Now they have to evaluate which pattern has the highest probability right now. They start checking the rules for each setup. Does the breakout have enough volume? Does the reversal have the momentum divergence it needs? Does the range scalp have clear support and resistance? While they're running through 3 different checklists in their mind, price moves. The pattern that was forming either triggers without them or it fakes out and reverses. The decision window closes. They enter 30 seconds later than the one setup trader, or they don't enter at all. In volatile markets, in markets with any kind of momentum, that 30-second delay means the entry is now worse by 10 or 15 ticks, sometimes more. It means their stop has to be wider or their target has to be closer. It means their risk-reward ratio just degraded from 3-to-1 to 2-to-1, or from 2-to-1 to barely 1-to-1. And this is not about being smarter than other traders. This is about having more compressed, automated pattern recognition than the trader on the other side of your order. The trader who sees it a half second after you do has already given you the edge. Your confidence is higher because you've seen this exact pattern work and fail hundreds of times. You know what comes next with a degree of certainty that cannot be taught, only earned. You know where the setup breaks down. You know what the price action looks like in the candles leading up to the entry when it's about to fail versus when it's about to run. You know what it feels like when the setup appears in the wrong market conditions versus when everything is aligned. This knowledge didn't come from reading a book or watching a course. It came from reps. And reps with one thing will always beat shallow reps with many things, because depth of pattern recognition is what generates profit, not breadth of knowledge. Let me show you what happens in your mind in real time when you trade multiple setups. You're watching a chart. Price is moving. You see what might be a breakout setup forming. There's a consolidation. Price is coiling. Volume might be picking up. But you also see what might be a failed breakout, which is one of your reversal setups. The consolidation could break and immediately reverse, trapping the breakout traders. You also see a potential range-bound scalp because price has been choppy for the last hour and there are clear levels being respected. Now you have 3 different trade ideas forming simultaneously in your mind, and each one has different entry criteria, different stop placement, different profit targets, different position sizing rules, different market conditions where they work best, different risk parameters. Your brain is now trying to evaluate 3 different probability trees at the same time while price is moving and the decision window is closing. Which one has the highest probability right now? You start looking for confirmation. The breakout needs volume to be legitimate. Does it have it? You check the volume bars. It's higher than the last few candles, but not dramatically higher. Is that enough? The reversal needs a momentum divergence. Is it there? You switch to the RSI or MACD. There's a slight divergence, but it's not perfect. Is it enough? The range scalp needs clear support and resistance that are holding. Are they holding? You zoom out to check if the levels have been tested multiple times. They have, but there was one false break earlier. Does that invalidate the level? While you're evaluating all of this, while you're checking indicators and changing time frames and trying to assess which setup has the best probability, price moves. The breakout that was forming either triggers without you, or it fakes out and you're glad you didn't take it, but now you're confused about whether your hesitation was wisdom or fear.
The decision window closes. You didn't take any trade, not because the setups weren't there, but because you were stuck in analysis paralysis, trying to determine which setup to trust, which pattern was the real pattern, which approach was correct for this exact moment. This is decision paralysis. This is not a lack of skill. This is not a lack of knowledge. This is a structural problem created by optionality. The trader who only trades breakouts doesn't have this problem. They see the breakout forming, they know the entry criteria by heart, they see whether it meets their rules or not, and they execute or they don't. They're not wondering if it's better to fade it or scalp the range. There's no internal debate. There's no comparison shopping between strategies. There's just recognition and action, or recognition of the absence of their setup and patience. But the damage from setup switching goes deeper than just execution delays and missed entries. Every time you switch between strategies, you alter your emotional relationship with risk. And this alteration happens below your conscious awareness. Imagine you take a loss on a momentum breakout trade. You followed your rules perfectly. The setup formed, you entered at the right place, you placed your stop where it should be, the setup failed. Price reversed and hit your stop. This is normal trading. This is part of the statistical distribution of outcomes. But now you're looking at the next chart and you see another breakout forming, except this time something is different. You remember the last loss. You remember how it felt when you saw the trade move against you. You remember that breakouts have been choppy lately, that several of your recent breakout trades have failed, and without realizing it, without making a conscious decision, you reduce your position size. You tell yourself it's risk management. You tell yourself you're being smart, being cautious, but really it's emotional protection. You're trading scared. Your brain is trying to prevent you from experiencing that feeling again, that feeling of watching your stop get hit. So you risk half of what you normally risk. You take the trade and it works. It runs exactly as your rules said it would, but you only made half the money you should have made. You penalized yourself for a previous loss that had nothing to do with this trade. Or worse, you see the breakout forming and you skip it entirely because of the last loss. You convince yourself the conditions aren't quite right. You convince yourself it's better to wait for a clearer signal. You stand aside and then you watch it run exactly as your rules said it would. It runs 20 points, 30 points, exactly the kind of move you're trying to catch. Now you're angry. Now you're in emotional debt. You feel like you owe yourself that missed profit. So when the next setup appears, when the next breakout forms, you overtrade it. You size up to make back what you missed. You're not thinking about statistics anymore. You're not thinking about risk management. You're thinking about recovery. You're thinking about getting back to even emotionally. You move your stop wider because you don't want to get shaken out like the last time. You hold past your target because you need this one to really pay you, to make up for the one you missed. And now you've completely abandoned your edge. You're not trading your setup anymore. You're trading your emotional reaction to the previous trades. Your position sizing is based on emotion. Your stop placement is based on emotion. Your exit strategy is based on emotion. This is the hidden loop that destroys accounts. The loss triggers emotion. The emotion alters execution. The altered execution creates new losses or missed opportunities. The new losses and missed opportunities deepen the emotion, and now you're stuck in a cycle where your results have nothing to do with whether your strategy works and everything to do with your inability to execute it consistently without emotional interference. The one setup trader has this problem too. Everyone who trades has this problem, but their recovery is faster. They know their setup so well that after a few clean executions, after a few trades where they follow the rules exactly and let the statistics play out, their confidence returns. They've seen the drawdown before. They've seen 5 losers in a row before. They've seen the recovery before. They trust the process because they have enough reps to know the process works over a large sample size. The multi-setup trader doesn't have that foundation. They've never executed anything long enough to see a full cycle, to see how their edge performs over 50 trades or 100 trades. They don't have the deep trust that comes from repetition. So when the emotional cycle starts, they have nothing to anchor to. They just spiral. Here's what nobody explains about edges in trading, what nobody tells you until you've lost enough money to figure it out yourself. An edge is not a universal truth. An edge is not something that works all the time. An edge is a conditional probability that exists only under specific market conditions, and those conditions are not always present. A breakout edge works in trending, expanding volatility environments where momentum is carrying price through levels. It fails miserably in choppy, range-bound, compressing volatility environments where every breakout is a false breakout and price just whipsaws back and forth. A mean reversion edge works beautifully when volatility is contracting and ranges are holding, when price is oscillating between levels like a pendulum. It fails catastrophically when volatility expands and support breaks, when the range breaks down and price trends away without coming back. These are not two sides of the same coin. These are not complementary strategies. These are two completely different regimes, two completely different market structures, and trading both means you're constantly trying to identify which regime you're in before you can even evaluate whether your setup is valid. The regime identification becomes a separate skill you need to master, a separate pattern recognition system you need to build. And while you're trying to master regime identification, while you're trying to figure out if the market is trending or ranging right now, you're not mastering execution. You're not building deep pattern recognition with your actual trade setup. You're stuck at the meta level trying to figure out which strategy to use. And this meta level analysis creates distance between you and the actual trade. The one setup trader solves this problem differently. They master one edge that works in one regime, and then they simply don't trade when that regime isn't present. They wait, they watch, they study the market, they do nothing. And doing nothing when your edge isn't present is not a lack of activity. It's not laziness, it's not missing opportunities. It's professional trading. Every legendary trader, every person who has made generational wealth from the markets has stories about sitting out of the market for weeks or months at a time because conditions weren't aligned with their specific edge. Stanley Druckenmiller has talked about going weeks without taking a position when he didn't have a strong conviction. George Soros has talked about waiting for what he called the moment of maximum certainty, the moment when all factors aligned before deploying significant capital. These aren't stories about patience as a virtue. These aren't motivational tales about waiting for your moment. These are stories about understanding at a deep level that your edge only exists some of the time, that the conditions that make your edge work are not always present, and that trading outside your edge conditions is just gambling with a complicated process attached to it. It's still gambling. It just takes longer and costs more in commissions. The fragility of edges becomes brutally obvious when you try to run multiple strategies simultaneously. You end up trading in conditions where some of your setups work and others don't, but you can't tell in real time which is which because you're seeing both patterns at the same time, and both patterns look valid according to their respective rules. So you take the breakout trade in a ranging market and lose. The trade met all the criteria for your breakout strategy, but the market was in range-bound mode and the breakout failed immediately. Then you take the mean reversion trade in a trending market and lose. The trade met all the criteria for your mean reversion strategy, but the market was in trending mode and the level you thought would hold just broke and kept going. Then you start doubting both setups. Even though neither setup was wrong, the market conditions were wrong, the regime was wrong. But because you're splitting your focus between multiple approaches, because you're trying to be ready for anything, you never developed the deep pattern recognition that would have told you this isn't a breakout environment right now. Wait for volatility to expand and momentum to pick up. Or this isn't a mean reversion environment right now. The range is broken down. Wait for price to establish a new range before looking for mean reversion trades again. The one setup trader develops this regime recognition naturally, almost accidentally, because they watch their setup fail in certain conditions enough times that they start to notice the conditions themselves. They start to notice that their breakout setup works great when the ATR is expanding and price is making higher highs and lower lows, but it fails constantly when the ATR is contracting and price is overlapping. They didn't study regime identification as a separate subject. They just took enough reps with their one setup that the pattern of when it works and when it doesn't became obvious through experience. They build a mental database not just of what the setup looks like, but of what the environment looks like when the setup has the highest probability of working versus when it's likely to fail, even though it looks valid on the surface. This is pattern recognition at a market structure level, and it only develops through massive repetition with one approach. You cannot develop this by taking 50 reps with 10 different setups, because you never get deep enough with any single setup to see the environmental patterns. Waiting stops being difficult when you understand it's part of the edge, when you understand that not trading is a position,
When you know you only trade one setup and that one setup only appears under certain conditions, waiting becomes the default state. It's not something you have to force yourself to do. It's not discipline in the traditional sense of resisting temptation. It's just what you do because you understand that trading outside your conditions is NEV, negative expected value. You're not sitting there feeling like you're missing opportunities while other traders are making money. You're sitting there knowing that every trade you don't take outside your optimal conditions is saving you money, saving you emotional capital, saving you the need to recover from unnecessary losses. You're not itching to get into the market. You're not feeling like you should be doing something just because price is moving. You're watching for your specific pattern in your specific environment, and everything else is just noise. Everything else is someone else's opportunity, not yours.
Look at the modern trading education space, and you'll see this pattern playing out everywhere, infecting thousands of traders who don't even realize what's happening to them. Traders collect concepts like they're building a library. They learn about order blocks, fair value gaps, liquidity sweeps, supply and demand zones, market structure breaks, trend continuations, consolidation breakouts, failed auctions, imbalances, institutional candles, and 50 other ideas that all sound sophisticated and professional. They watch videos, they take courses, they join communities, they can explain every concept in detail, they can identify them on historical charts, they can draw the zones and mark the levels and point out where the smart money entered or exited, but they can't trade any of them profitably because they've never executed one concept enough times to develop the unconscious competence that allows them to see it forming in real time under pressure and act without hesitation. They have a framework, they have a vocabulary, they have a way of describing what happened after it happened. They don't have an edge. The edge comes from repetition. The edge comes from seeing your setup form 500 times and noticing that these 3 microconditions that nobody talks about, that aren't mentioned in any course or video, are what separate the trades that work from the trades that fail. You only notice those microconditions after massive repetition, because the first 100 times you take the trade, you're focused on getting the basic structure right, on making sure you're identifying the pattern correctly. The second 100 times, you're focused on execution and risk management, on getting your stops in the right place and your targets at logical levels. The third 100 times, you start noticing the subtle differences that nobody taught you. The way price approaches the level matters. The way volume behaves in the last 3 candles before the entry matters. The way the higher time frame structure supports or contradicts the lower time frame signal matters. The way price moved in the 12 hours before your setup appeared matters. These are the real edges, the actual advantages that allow one trader to have a 65% win rate, while another trader using the same basic setup has a 45% win rate. And these edges are completely invisible until you've done the reps, until you've taken the same trade structure so many times that the subtle variations become obvious. The trader who splits those 500 reps across 10 different setups never gets to rep 300 on anything. They never get deep enough. They stay stuck at the beginner level on everything permanently until they decide to specialize. So here's what you need to destroy in your own mind right now. What you need to accept as true, even though it contradicts everything you've been told about being well-rounded and having multiple skills. The belief that more setups equal more opportunity is false. More focus equals more money. The belief that you need to be ready for any market condition is false. You need to be a master of one condition and completely irrelevant in all the others. The belief that professional traders have diverse toolkits they rotate through depending on market conditions is false. Professional traders have 1 or 2 core edges they've executed thousands of times over years or decades, and they sit on their hands the rest of the time because they understand that trading outside their edge is just a slow way to lose money. The belief that learning new strategies is progress is false. Repeating one strategy until it becomes unconscious, until it becomes automatic, until it becomes so deeply embedded that you can execute it under pressure without thinking is progress. Everything else is motion without movement. The market doesn't care how many books you've read or how many concepts you know or how sophisticated your vocabulary is when you're analyzing charts after the fact. The market pays you for execution quality, and execution quality is a direct function of repetition depth with a specific approach. You're not losing because you don't know enough. You're losing because you know too much and haven't mastered any of it. You've mistaken information accumulation for skill development. You've mistaken learning for improvement. You've mistaken being busy with being productive. Every new strategy you learn before mastering the last one is a reset button. Every time you switch approaches, every time you decide to try something different, you're starting over from zero.
Every month you spend dabbling in 3 different methods is a month you didn't spend getting truly dangerous with one method, and being dangerous is what makes money in this business. Being flexible makes you feel smart. Being scattered makes you feel busy. Being dangerous, being so specialized that you can execute your one edge faster and with more confidence than 99% of traders, that's what makes you profitable. You have 2 paths in front of you right now, and the path you choose in the next few days will determine whether you're still having the same conversation with yourself a year from now or whether you've actually built something real. The first path is where you continue exactly as you have been. You keep learning new setups, you keep watching new trading videos on YouTube, you keep scrolling through trading Twitter looking for new ideas, you keep adding tools to your arsenal convinced that the next strategy or the next video or the next concept will be the missing piece. You keep telling yourself that once you have enough pieces of the puzzle, once you understand enough different approaches, it'll all click and you'll suddenly become consistent. You keep taking trades across multiple strategies, and you keep getting mediocre results because you're mediocre at everything you do. You're not bad at any individual strategy, you're just not good enough at any single thing to have a real edge over other traders. You end up as a permanent student, always one course away from figuring it out, always one new strategy away from consistency, always optimizing and adjusting and searching, but never actually mastering anything. You stay busy, you stay engaged, you stay interested, you stay broke. Your account slowly bleeds through commissions and small losses and missed opportunities and trades taken in wrong conditions. You tell yourself you're learning, you're paying tuition, you're getting experience, but the truth is you're just resetting yourself over and over, never giving any single approach enough time to develop into real pattern recognition. The second path is where you pick one setup, one edge, one approach that makes logical sense to you based on how you think about markets, and you execute it 500 times over the next year or 18 months. Just one thing. You track every trade in a journal, you note the conditions, you notice every pattern, you refine the micro conditions that separate winners from losers. You learn what the failures look like before they fail, what the warning signs are, what the price action does in the candles before a failed trade that's different from the candles before a successful trade. You develop the instant recognition that allows you to execute faster than conscious thought, faster than doubt, faster than fear. You become so good at this one thing, so specialized in this one pattern that when it appears, you're not hoping it works. You're not praying this is the one. You know it works because you've seen it work 200 times and fail 300 times, and you know exactly what separates the two groups. You build your account not through activity, but through precision. You sit out of the market for days or weeks when your setup isn't there, when the conditions aren't aligned, when the regime doesn't favor your edge. You don't feel guilty about waiting. You don't feel like you're missing out. You feel professional. You feel like you're doing exactly what you should be doing. And when your edge appears, when your setup forms in your conditions, you execute with size because your confidence isn't based on hope or belief or positive thinking. It's based on reps. It's based on data. It's based on having done this exact thing hundreds of times and knowing with statistical certainty that over a large enough sample, this approach makes money. Everything else is noise.